Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at MarketSite, we have Swartz. He's an attorney with the Capital Markets and Merger and Acquisitions Group at Vinson Elkins to discuss climate risk and opportunities for sustainable real estate in the energy transition. Zach, it's great to have you with us at MarketSite. Welcome to Trade Talks.
Thank you for having me, Jill.
How does commercial real estate contribute to climate change?
Yeah, so I guess I would break it up in sort of two major ways. They're somewhat intuitive, but I think the first way is the actual construction of real estate, right? So that's what a lot of people call embodied carbon. And that involves, real estate obviously requires a lot of concrete and steel, a major consumer of concrete and steel. When you combine concrete and steel, they actually account for approximately 10% of global greenhouse gas emissions, which is a big number. And so, that's sort of point one. And then point two is sort of, once you've constructed a building, right, you have to operate it. And so that's operational carbon. So that's, obviously real estate, sort of has to draw electricity to, for lighting, heating and cooling, appliances and sort of other uses of electricity. So those are kind of the two big contributing factors for real estate. And when you add all of that up, it actually accounts for, according to most experts, approximately 20% of global greenhouse gas emissions, and accounts for approximately 40% of the world's energy usage. So those are big numbers, and notwithstanding a lot of the focus in energy transition on some of the sort of sexier industries like electric vehicles and things like that, we're never actually going to meet the net zero goals that we have kind of as a society unless we figure out how to decarbonize real estate.
I never thought of it that way, and here we are looking around Times Square where all the lights are here and all the massive buildings. I never thought about it in that way. And real estate does not just contribute to climate change, it's also impacted by it. How so?
That's right. So I think there's two ways to think about that as well. So there's sort of the intuitive way, right? There's physical risk. So I think that's kind of obvious, right? Climate causes things like hurricanes, floods, tornadoes, wildfires, mudslides. All of that can damage real estate, right? And so that's obviously sort of the physical risk. And there's also sort of a chronic physical risk that's maybe not as obvious, but I think a lot of people are aware of, right? Which is, what if you own real estate along a coast of a major ocean, right? We have rising sea levels. There's no guarantee that real estate's going to be there forever. So that's physical risk. And then there's transition risk, which at least to me is a little less intuitive. But as the name implies, that's sort of related to the transition to a lower carbon economy, right? So that can involve things like sort of increasing government regulation. As we set net zero targets as a society, we're going to see more government regulation affecting things like real estate. And also sort of changing consumer demands, right? As consumers become more aware of it, investors become more aware of it, they're going to demand greener real estate whenever they make investment and leasing decisions and things like that.
What is the building sector being tasked to do, and what are the risks associated with the efforts to transition to low carbon economy? I mean, is it realistic at the end of the day?
Yeah, so I think it is a short answer, but I think I'd sort of go back to what I was saying before, right? We have to reduce embodied carbon. So how do you do that? I think it's really exciting. There could be a lot of innovation and technology in the processes that we use to construct buildings, right? So we at Vinson Elkins actually work with a client that is developing this really cool panelized technology. So they assemble these panels. They can build a building with something like 44 different types of panels. They can assemble the panels in an offsite warehouse. They can then haul the panels to the building site and click them together almost like an erector set.
Right.
And they can do that. That can reduce the time that it takes to actually construct a building by like 50%. And so naturally, there's a reduction in the greenhouse gas emission just with the just from that sort of reduction, more efficient, right, construction. And by the way, whenever they do build those buildings, they're actually designed so that whenever you actually build them and put them into operation, they operate on a net zero basis. So that's really cool. And then, operational carbon, like I said before, I think that's something that there's already been a ton of great progress on, right? So LED lighting, right? Heating, ventilation, and air conditioning systems that are just more energy efficient. Things like, sort of automatic shades that, whenever there's a sunny day, they come down automatically. That reduces the amount of air conditioning that you need to, cool a building, things like that. So, those are sort of the two, I think, ways that we can decarbonize real estate. And then in terms of your question about sort of the transition risk, I mentioned government regulation. That's something that we're continuing to see more and more of at the local and federal level, but also changing consumer demand as well. I think as time goes on, you're seeing more and more tenants and investors just demand greener buildings when they make their decision about where they want to have their business, where they want to live, and where they want to put their hard-earned dollars in terms of investing in real estate.
And speaking of dollars, this all comes at a cost. It is not cheap for the energy transition. How much money is estimated that you're going to need to fund this energy transition? And do you have any early movers that are seeing economic benefits now?
Yeah, so if you just remove real estate, just like say globally, how much is it going to take to fund the energy transition? And by the way, when you say energy transition, let's define it. 2050 net zero is kind of what's set forth in the Paris Accord. How much money is that going to take? I think there's a lot of estimates out there. Anywhere, I think most people agree it's at least $100 trillion. I've seen numbers as high as $160 trillion. Obviously real estate is not all, and actually just to put that in context, the GDP of the entire world in 2021, last year, was $95 trillion. So just talking about a massive amount of capital, right? And real estate's obviously not all of that, but if real estate does actually account for 20% of greenhouse gas emissions, like I said earlier, it's trillions of dollars just to decarbonize real estate, right? So that is, I think, kind of the sort of amount of capital that we're facing. And I do think it's realistic that we can actually expect that we can actually get there based on some of the sort of technological advances that I was describing earlier. The question is, can we get enough capital sort of into the system to actually fund it to make it happen?
What's the government's role in this? We need the infrastructure to be able to support the energy transition.
Right, yeah, so I kind of alluded to that earlier, right? So, you mentioned we're sitting here in beautiful Times Square, Midtown Manhattan. New York, a couple of years ago, passed Local Law 97. Local Law 97 is a building emissions limits law. The first actually round of emissions limits for building, this building itself is probably, it's any building over 25,000 square feet is subject to it. There are some exceptions. The first actual sort of emissions limits under this law come into effect in 2024. That's right around the corner, right? And if you don't, and then there's stricter limits actually, so they kind of ratchet up the intensity as time goes on. That come into effect in 2030. If you're not in compliance with those limits, you could face stiff, fines and penalties. So that's kind of the local level, and that's happening in other states well. District of Columbia has a very similar statute. And then we're seeing actually a lot of activity at the federal level as well, right? So in just December of last year, the Biden administration issued an executive order where they directed the federal government to decarbonize, to get to completely net zero in their federal buildings portfolio by 2045, which is actually 5 years earlier than most net zero targets, which are 2050. And sort of as an incremental step along the way, they want to decrease greenhouse gas emissions from the federal building portfolio by 50% by 2032, which sounds like a lot of time, but it's actually not if you think about it sort of in the grand scheme of things.
2050 is not that far away either. Kids, little kids now could potentially be advising clients in 2050. It's 20, let's do the math here, almost 27, 28 years away. Right. It's not that far off. What is the green premium?
Yeah, so or the greenium, as shout out to ESG Today. I saw that this morning. So in real estate, it means a couple of things. So sort of point one, this kind of goes back to what I was talking about before. Studies have actually shown that you can get a rent premium on buildings with green certifications like LEED, Fitwel, Energy Star, things like that, of up to about 7.5%. And then they can actually have a sales premium of 6%, right? So that's a premium right there. And then JLL did a study where they actually surveyed leading real estate investors. 63% of those investors said that they strongly agree that greener buildings can facilitate higher tenant occupancy, tenant retention, and those premiums and the rent premiums and sales premiums that I mentioned. And then the other way that you see it is really in financing, right? So how do you finance real estate? Obviously with debt in most cases, or a lot of cases. So there are a lot of providers of capital to the real estate industry out there that are looking to put money to work in green projects. So you won't have access to those projects unless you have green real estate. And we actually seen that, that's sort of the building level, and then at the corporate level, we've actually seen a number of publicly traded REITs do this, where they get corporate level debt And they actually build right into the documents sort of metrics that if they hit, they can actually knock basis points off of their interest rate. So for example, if you have a portfolio of office properties, if you can get X% of those properties, a LEED or Fitwell certification, will knock 20 basis points off of your interest rate. So when you combine, sales premiums, rent premiums, better access to financing and better financing terms, what does that lead to? It leads to better returns for investors. So Barron's did a report earlier this year where they looked at what they call the 10 sort of most sustainable REITs and found that they had a higher dividend yield than other REITs in the S&P 500 and outperformed the S&P 500 on a total return basis.
Well, that's good to know because everyone's hunting for income in such a relatively low interest rate environment. And to wrap up here, at Vinson Elkins, obviously you're advising clients on this. Are you seeing enough companies start to work on this? Or are they being proactive about it?
I think absolutely. It's funny because we have been talking to clients about this. Is something the SEC, for example, has been sort of hammering on the door for a long time, and we were sort of turning around and doing that to our clients. And a lot of our clients in the real estate industry were like, "We're in the real estate industry. This doesn't really affect us." But we've seen a significant increase in the past, call it 2 years or so. General counsel, boards of directors of publicly traded clients coming to us and saying, what do we need to do to wrestle with these issues? Because we think it's going to be a really important part of how we operate our business going forward.
Right, interesting. All right, Zach, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.